Kit, you also have a note out this morning saying worrying about inversion. Overall, if you look at trade, and we'll talk a little bit about the Fed and what we heard from the St. Louis Fed governor a little bit later, but can trade actually hurt Treasuries at this point, or what's priced in?
I think there's relative calmness priced in at the moment, in the sense that it looked as if this issue was going. That I think the markets learned that President Trump likes doing deals, wants to do a deal, is pretty quick to do a deal if you give him half a chance. So the fact that it's coming back will add to some of the concerns. We have problems with trade. We will get eventually slower growth, but we will get higher prices of some things. It's not. There's no trade war that was disinflationary that we found for a long time. So it's bad for a bunch of countries, including the US, but it's not good for inflation.
But are you expecting anything out of this White House meeting today, or is it kind of like, as long as it doesn't go badly, then you'll take it?
I'm assuming that they're still trying to do a deal. So unless they all walk out hating each other, that they'll be working towards finding a deal. It's in both parties' interests to get something done over time that they can declare as a victory, however we define that.
Okay, Kit, talk to me a little bit about, so we have this chart up, which is a great chart, thank you to Hillary Clark, and it's basically looking at the Fed funds rate, and you can see it's kind of, the R where the rate is no longer stimulative. Are you worried about some of the Fed policies?
No, look, I think what the Fed's done really successfully with their dot plot, with John Williams's work on where our star is guide a market so that we've had a much flatter curve than we would have had, where long yields have not got so much of a risk premium priced in, and we're all comfortable with what's going on. That's helped depress volatility, helped boost risk assets. It's helped prevent the dollar getting strong as the Fed was tightening, because the long end of the curve hasn't dragged it. I thought John Williams was more interesting at one level yesterday than James Bullard, because he's talking about what do we do when we get to neutral. I mean, I can see that if you've given
what do they do?
Well, if you've got long-term guidance saying this is where rates will be several years down, and you raise rates above them, we will invert the yield curve, because what else do we do? So you have to back off the guidance at neutral if you think that, again, as Mr. Bullard said, that if you think that an inverted curve is going to depress inflation expectations and be a bad thing. So
where do you stand on that? I mean, does an inverted yield curve automatically mean that there's an impending economic slowdown?
No, okay, so historically, an inverted yield curve has resulted in a recession after a period of time. A flat yield curve doesn't. So, let's not worry until we've got a properly inverted curve. There's less information now because we've depressed longer dated yields with the forward guidance. I don't see how we can think that that's a bad thing to have done, to have lower long-dated yields through the last cycle. So, I think we have to get used to a flatter curve. But I do think that if the signal comes out that neutral's still where neutral is and rates are above it, policy will be tight, presumably because inflation is getting higher than they thought it would, and presumably at that point we're at the back end of the cycle and we will get a slowdown. That's the idea.